when we talked about Ias 12, what we covered in the previous recording were the basic requirements of Ias 12. In your advanced paper, there's going to be more advanced issues to be dealt with. So before I get into the advanced bits, let's just quickly recap what we talked about in the previous recording. So this is covered by Ias 12. Okay, in talking about deferred tax, there were a number of terms that we defined and talked about. Accounting profit. This is the profit arrived at by applying accounting standards. So your revenue, your expenses, your assets and liabilities, when you bring all of that together and you generate profit, that is called an accounting profit. To determine the tax payable, we take that profit and we make adjustments by applying taxation rules. There's going to be allowables and disallowables. When we apply the taxation rules on accounting profit, we arrive at what is called taxable profit. There's going to be some differences between taxable and accounting profit caused by these rules of allowables and disallowables. These differences are either permanent, and these differences can be temporary. The word permanent simply means there is no equivalent. So if something is disallowed, it's not replaced either in terms of amount or in terms of timing by tax whatsoever. Temporary means there's a difference in timing or in amount, but the difference is for the time being only. Over a longer period of time, these differences are going to cancel out. Those differences are called temporary, and deferred tax is based on those differences that are temporary. And these differences are of two types. There is what is called deductible, and there is what is called taxable. If the difference will cause the company to be charged less tax than otherwise would be the case, it means that the additional tax, once that difference reverses, will need to be taxed. So that difference is called a taxable. If a company appears to be charged more tax as a result of that difference, and that difference is expected to reverse or cancel out, it's called deductible. Why? Because the overcharge will be recovered in the future. So deductible means recoverable, and we'll be talking about a deferred tax asset. Taxable means payable, which means that we'll be talking about a deferred tax liability. And then we looked at the concept of tax base, and we said a tax base is the tax equivalent of the accounting amount. So if you do an asset such as PPE Ias 16, when you apply Ias 16, that is the accounting amount. If you take the same amount and you apply capital allowances, you're going to arrive at a tax base. If you take an amount called research and development and so on and so forth, what you derive at by applying an accounting is called the accounting amount. The application of the tax rules to that asset or liability gives you the tax equivalent, and that amount is called the tax base. And therefore we have then the accruals and matching concept. Now you know that accruals means we account for expenditure when we incur it, and we account for revenue when we earn it, and the revenue earned is matched with the cost incurred in earning that revenue. Therefore, strictly speaking, if you make a profit, that profit, which is the result of revenue, should be matched with the cost of making the profit, which is called tax. So if you are postponing tax, and this is why it's called deferred tax, in other words, you are being charged a lesser tax simply because of a timing difference, because of a temporary difference. What you're postponing is the payment, but the amount should be accrued. Just like if you're overcharged, what you're postponing is the recoverability, but the asset should actually be accounted for. So that's how we apply the accruals and matching. Now all of this was reduced to an exam technique which simply says to compute deferred tax you just need two things. You need the carrying value of the asset or the liability, and then you need the tax equivalent, which is called the tax base of the asset or liability. And we're talking about those differences that are temporary. This difference here, when you apply the rate, e.g. 30%, this amount here becomes the deferred tax liability or deferred tax asset closing balance, and the movement between opening and closing is what will go to the profit and loss account. Again, deferred tax is one of those standards that is not so easy to pick up, so you need to slowly just go through this a few times until you understand it. So what we're saying here is, if the carrying value is an asset, and this asset reduces, if an asset reduces, remember our understanding of movements in assets and liabilities, what we have is a loss or expense. To introduce an expense in the books, you have to create a liability. Therefore, the result of this is called a deferred tax liability. So this will be a deferred tax liability. If on the other hand the asset increases, when an asset increases, what you have is profit or income. To introduce income in the books, you create an asset, and therefore this will be called a deferred tax asset. If we're talking about a liability, and the liability decreases, if a liability decreases, we have income. To introduce income in the books, we have to create an asset. So this is going to be a deferred tax asset. If on the other hand, the liability increases, what we have is expense, and to introduce an expense, we have a liability. So just try and follow this thinking framework, because I think it's the easiest method or approach to dealing with deferred tax, at least from my experience as a lecturer. And that's what you're doing now. These are the basic requirements of Ias 12. I'm going to take you through the advanced bits. And the advanced bit simply means, at this level, we basically are only talking about PPE. And PPE applying the cost model. Let's go through the different standards that we'll have covered and to see how deferred tax implications are actually imputed. Now, regardless of what asset or liability I'm talking about, that thinking framework is going to be very useful to you. This thinking framework is going to be very useful, because all you have to do is, if you can find this difference, you apply the rate, then that gives you the closing balance, and the movement is going to be what will get charged to the profit and loss account. So if we're talking about Ias 16, so these are the advanced bits, if I can call them that. If we're talking about Ias 16 and we have revaluation, Ias 12 says, if you have a revaluation surplus, whether that asset is sold or not, the deferred tax must be computed on the revaluation surplus, meaning that the tax base does not change, but the accounting changes, which means that the accounting value increases, the tax base remains the same, which means that the asset is more than the tax base. Therefore, there's going to be the deferred tax liability associated with the surplus. So, the only difference there is that the actual deferred tax on the surplus will not go to the profit and loss account, but will be charged to revaluation reserve or other comprehensive income. Next, when you have Ias 19, if you remember, you're going to be making a provision at the same time you're accumulating planned assets. So you're either going to have a net liability or you're going to have a net asset. Now, in terms of the tax, it just depends on the rules applicable in that jurisdiction. In most countries, there are no recognition of provisions by tax. In most cases, what will be recognized is either the contribution that you're making or the benefits that's going to be paid once the employee actually retires, which means that the tax base is going to be zero, whereas the carrying value will be whatever is the net liability or whatever is the net asset. Next, Ias 38. If you remember, in accounting, research is written off, development expenditure can be capitalized to the extent that it meets specified criteria. As far as tax is concerned, both research and development are written off. So whereas there's going to be an asset in accounting, there will not be an asset in tax. So again, there will be a difference there, and that difference will eventually be reversed. Why? Because this asset will be amortized, and at the end of its amortization period it will be zero, just like it is zero for tax purposes. Next, your IFRS 2. Your IFRS 2, again, you're making a provision depending on your assessment of how many employees will be entitled to either the share appreciation rights, as the case might be, and therefore you're going to have a provision at the end of each year. For tax purposes, in most tax jurisdictions, you'll find that the provisions are not recognized until the rights are exercised. So until you make the payment at the end of the vesting period, there will be no equivalent liability recorded by tax. Okay, so all the standards that we've done, they can be, deferred tax implications as the case might be. Next, we have losses. When you make a loss, for accounting purposes, the loss is accounted for immediately. However, for tax purposes, the tax legislation says the loss that should be recognized will depend on the profits available to cover that loss. So you might make a loss of 50, but if the expected profits are only 10, it means that there's going to be a timing difference of 40. Why? Because for tax, only the 10 will be taken into account, whereas for accounting, the entire loss is actually going to be taken into account. Next, you have the group aspects of deferred tax. In a group aspect, you have a subsidiary and you have a holding, and what you have is these figures are combined to form group accounts, which means that the group accounts will have a different figure and the subsidiary is going to have a different figure. Okay? Ias 12 says we must always take the subsidiary figure as the tax base. So this will be the tax base and this will be the carrying value. And we do have adjustments that we make before we combine or prepare group accounts. So for example, inventory is moving between companies within the same group. For example, if the group transfers inventories to a subsidiary, at the group level, we will need to remove the unrealized profit, whereas the subsidiary, that profit will still be there. So there's going to be a difference. Sometimes the assets in the subsidiary may have to be revalued before consolidating. If they're not revalued in the subsidiary because they don't follow the fair value model, then there's going to be a difference. So all you have to do is find out what figures are being affected there, take the subsidiary figures as a tax base, take the figures that are included in the consolidated accounts of the carrying value and just apply the reasoning there, because this is going to be an asset or liability, and the resulting issue there is going to be either a deferred tax liability or deferred tax asset. Okay, we're going to go through a fairly comprehensive example on deferred tax, and again, in all of these, my recommendation to you is just repeat, just do it again, not once, not twice, as many times as you need to. The more of this you do, you find that the mind on its own will be picking up a lot of this information fairly easily. Okay, so let's go through a question on deferred tax. And as I say, this question is quite comprehensive because it gives us a chance to actually cover a number of issues that we're talking about here. Okay, we're given income tax focuses on the statement of financial position in accounting for deferred tax, which is calculated on the basis of temporary differences. The method of this can lead to accumulation of large tax assets or liabilities over a prolonged period, and this could be remedied by discounting these assets and liabilities. There is currently international disagreement over the discounting of deferred tax balances. Explain what the term focus on and temporary, and discuss the argument for and against long-term deferred tax. So, very quickly, there are two things there. Focus on the statement of financial position and temporary differences. Okay? Temporary differences, the discussion there is, you say there are differences that will cause for there to be a difference between accounting and taxable profit. Some of those differences are temporary, and temporary means those differences are for the time being only, which in the final analysis, for the reason of timing, for the reason of amount, are going to cancel out. And then you state that there are two types of differences: taxable, which will result in additional tax being payable in the future, and then you have recoverable, which will result in tax being recovered in the future. Okay, statement of financial position. This is the balance sheet perspective that we spoke about in the first lesson of accounting standards. All accounting standards develop the standards from that perspective, and therefore you're looking at assets and liabilities. You're looking at the carrying value of assets from the accounting perspective, the carrying value of liabilities from the tax perspective, and you're computing the difference. The argument here is that tax recoverable or tax payable, which is postponed or deferred, this is payable in the future or recoverable in the future. So there's an argument that in the same way that we discount a number of issues, if you go to Ias 37, we discount. If you go to some IFRS 9, we discount. But there are standards like IFRS 2, for example, where we don't discount, and those are exempt from discounting. Now, the reason for discounting is obviously to reflect the time value of what you're talking about here. Now, what is being postponed here is the amount payable, and the amount payable, according to revenue, is not really looked at in terms of net present value. So this must reflect what is actually going to be paid or what is actually going to be recoverable. The tax authorities don't deal with discounting in determining tax. And in any case, discounting will require that you determine a discount rate, which will make this doubly more difficult, because deferred tax as a concept is not very easy. So therefore it's going to be even more complicated if you begin to apply discount factors, because remember, to determine a discount factor 10 years from now is not very easy. So this will make it doubly difficult, and this is why Ias 12, in terms of accounting, there is no requirement for discounting. So just, jot down some points there. Okay, my main interest is really in the figures there. You have Copper Energy, a public listed company registered in Zambia, which has decided to adopt provision of that for the first time. Okay, if you adopt a standard for the first time, there's some accounting that you need to do, and we'll talk about that much later. The amounts of deferred tax provided as set out in the notes of the group is that. So it's a group, which means that we may have some group aspects there. Okay? You have the tax depreciation in excess of that, other temporary differences, and so on and so forth. And then you are given some notes that are relevant to the calculation of deferred tax as at 30th November 2011. So as you're reading this, the idea is to identify the tax base, the carrying value, as well as the tax base. Okay, so let's read this here. CEC acquired 100% holding in Kariba Water. The subsidiary does not plan to pay any dividends for the financial year or in the foreseeable future. The carrying value of the financial statements of this investment is made up as follows. So we're given the carrying value of these figures, 76, 14 to give us 90. So what we have is carrying value of 76 and we have goodwill of 14. Now we know that goodwill is not subject to any deferred tax. So I'm going to lay out here the way this should be answered. Okay, so this will be answered as follows. So all I need is to identify, okay, I'll explain the notes there, then I need to know the carrying value. I need to know the tax base, and I need to know the difference, because remember, all you have to do is find the carrying value, compute the difference, and you apply the rate to that difference to give you whether you're talking about a deferred tax asset or deferred tax liability. So I have two items there. I have goodwill as well as the carrying value of the net assets. Now we know that goodwill is not subject to a deferred tax. So I can write here goodwill okay. We don't really consider this because it doesn't constitute any difference there. Then we have the carrying value of the net assets in the subsidiary, which is given as 76. If you go down here, we are told that the tax base of the net assets of the subsidiary, so those assets, that's the carrying value, the tax base is 60. So we come here and we write the tax base is 60. This asset has reduced to this by 16. If we have an asset reducing, what we have is a deferred tax liability. So I'm just going to label that as deferred tax liability. So learn the skill of getting marks, and the skill of getting marks is simply getting one mark at a time. So you may not know everything, but everything that you write down in there is going to give you some marks. Let's go down. Immediately after acquisition, CEC had supplied KW with inventories amounting to 30 at a profit of 20% on selling. The inventories are not being sold, which means that the subsidiary will be recording the 30, whereas the group will be reporting, will be removing the profit. So 20% of 30 is 6. If you remove 6 from 30 is 24, and remember, whatever is recorded in the group becomes the carrying value. Whatever is in the subsidiary becomes the tax base. Therefore, what we have is inventories, 24 is the carrying value, 30 is what is in the subsidiary. Therefore, we have a difference of 6. The asset has increased, therefore we have a deferred tax asset, and to distinguish that from the others, I will put that in brackets. Next, the carrying value of the property, plant and equipment, excluding that of the subsidiary, is 2.6, and the tax base is that. So I'm given PPE, it is 2.6, and this is 1920. 2.6 minus 1920 is 680. The asset has reduced, therefore I have a DTL. And I'm just reading this and dealing with it on the basis of the understanding that we've just developed there. Next, other temporary differences excluding the subsidiary amount to 90. So we are given other differences there, other temporary differences, and the way taxable, meaning that is a DTL. So taxable means DTL. So 90 is DTL because taxable means that. Okay? We go down. The liability for health care benefits in the statement of financial position had arisen to 100, so that's what we're recording in the books. And tax base is 0. Healthcare benefits are deductible for tax purposes when payments are made. So that, will cancel out when the payment is made. So for now, we have healthcare benefits. First of all, these are assets. Then we have healthcare benefits, which is a liability. We have 100, 0 here. The liability has reduced, therefore we're going to have a deferred tax asset. And I put that in brackets for that reason. We go down. CEC group incurred 300 of tax losses in 20X0. Under the Zambian tax laws for companies like CEC, tax losses can be carried forward for 3 years only. The taxable profits for the years ended were anticipated as that. The auditors are unsure about the availability of taxable profits also. We are not sure about these, okay, as the amount is based on the projected. So let's just correct this. So this should come here. Okay, so these profits, we're not sure about them. These profits we're sure these will be recovered this year. So the amount of profits available for recovery in future is 100. Therefore, this is the maximum losses that can be relieved. Okay, so we say losses. Okay, the carrying value is so the maximum losses that can be relieved is 100. Or shall we say 100 here, 0 here, 100 here, and we also have a deferred tax asset. We put that in brackets. This is a loss. Recoverable means deferred tax asset. So what will be recovered is 100. That's the maximum difference that is going to be regarded as temporary. The other difference will be regarded as permanent, because remember, in deferred tax we're only looking at temporary differences. Next, we go down here. Income tax of 165 when property disposed of becomes payable under the deferral relief provision of the tax laws. There'd be no sales or revaluation of property during that. Okay, so if we have tax of 165, which is equal to 30%, we need to find the value of this, because remember, we're not talking about tax here, we're talking about the carrying value and the tax base. And if that is revaluation, it means that it's the carrying value aspect and not the tax. So if we say 165 times 100 over 30, this will give us the value of the property that we're talking about, and this is going to be 550. This is going to be 550, which means that the PPE, the property sold, will give us 550, and there's going to be a deferred tax liability to be provided on this. So if you like, you could say this. The surplus of 550, the asset has reduced to zero, therefore what we have is a loss, and therefore you need to have a deferred tax liability in there. Okay, when you add these figures, you're going to get 1130. When you add those figures, you're going to get a net of 1130. And if you compute the deferred tax on all of that, what you're going to get is 338. So this times, okay, this needs to be broken down into the different components because the tax rates are very, very different. So let me just get rid of this first. We know that the tax in relation to the subsidiary is 25. The tax in relation to others is 30. So your 16 and your 6 will be at 25, whereas the others are going to be at 30. Okay? So if you break down that into the components, what you'll find is this 16 will be at 25%. The 6 will be at 25%, whereas these are going to be at 30%. And this is going to give you a net calculation, if you compute those figures, of 338.8.5. Okay, now if you go to the subsidiary there, this is what we are told. There were no other differences other than those set out above. Therefore, what we have is balance brought down, according to this, is 280. The question says there that, and the deferred tax expense, blah, 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 blah. There were no other temporary differences, and the opening balance of deferred tax using Ias 12 is 280. And then we have this difference arising from, so if we go up here, this is what we'll find. The carrying value of the assets for, in terms of computation of goodwill is 76, and then we are told that the tax base was actually 60, so we actually have a difference of 4. Okay, so in terms of the subsidiary, we also have a difference of 76 minus 60, which is 4 times 76 minus 60 is 16 times 25%, and that is going to give you 4. So 284 is going to be your opening balance. Therefore, the movement here, so if this is closing and this is opening, the movement there is going to be the figure that will go to the profit or loss, which is going to be 54.5. Okay, now granted that part of this figure will be a split between which part goes through the main part of the P&L and which part goes through the OCI. The point that I'd like to make here is that you may not get to the end of these figures, but just pick each figure and deal with it. In other words, get the individual marks, forget about the total. One of the reasons why you don't get 100% is because you're a student and therefore you will not get everything right. So out of here, it's possible that you may not get something right. For example, losses were not so easy to determine. Some of them were easy to determine, so get the ones that you can do and you'll be given credit for that. Why? Because your job is simply to score marks towards your 50 or 60% pass mark, as the case might be. Okay, this is a good question to go through. Why? Because it's brought together a number of issues there. We've got losses, we have group aspects, we have provisions, and so on and so forth. So it's a good question to repeat and go through as a way of consolidating this material. Okay, this is the end of this recording.